Okay, everybody, thank you again for being part of the Plan Giving Boot Camp, and welcome to the fifth session. Probably the most important session for many people who want to take this course because this sort of gets at the heart of what people are trying to learn about, which is the vehicles. Um, so anyway, just if you have any questions, please use the text feature. Everybody's on mute, so I can't hear you, which does help the sound. But please feel free to send a little text. I'll stop and answer the question. Okay, so I don't want to waste too much time with introduction stuff. Okay, so what are we going to learn today? We're going to do an overview of life income gifts in general. Now, I'm calling them life income gifts. Sometimes people call them deferred gifts. I'm using the word life income, even if it's not the best terminology because not all these are for life. But I like to lump them all together. I call them that, and sort of keeps us on page for that. Okay, this is what we're talking about generally speaking, and then we're going to get into some of the details. One of which is charitable gift annuities, very very important, and equally important charitable remainder trusts. Even though if you watch my webinar from a week and a half ago, 2 weeks ago, there are a lot less of these things. At least charitable remainder trusts, a lot less of them being done in recent years, but they are very important as you're going to find out through this presentation. And we're going to do a couple unusual charitable gift annuity studies. Part of the course is sort of give you an overview. A lot of it just sort of cramming information in there. So I'm going to throw some more complex cases at you just so you see what some of the possibilities are. But we're not going to be able to spend enough time to really go in depth. So you'll see some of the some interesting options back on the gift annuity side at the end. Okay, so how life income gifts work. Again, I'm bundling them all together. And I use these pictures from PG Calc. I think somebody from PG Calc has actually taken the course, so I like to use their graphs, and I fix them up a little bit myself. But in any case, this is a simple picture, and it applies to all of these gifts where somebody's gifting something. I was thinking about changing that word from property to something of value, hopefully cash or marketable securities, but could be something else depending on the option. They're giving it to this life income gift. Again, we're going to talk about the different ones today. And then they're getting back income tax deduction, partial. We'll talk about that in a second. And fixed payments. Could be for life or could be for a term of years. And the remainder is going to go to charity. And again, this is right out of PG Calc. I didn't change any of the text. And this picture applies to all of these different vehicles that might get you confused. So to alleviate the confusion, they're all operating off the same principle. 1, 2, 3. Just take a look at that picture. Okay, so let's look at some of the common features, then we'll look at the details. All right, so all life income gifts. Let's talk about we're always talking about either charitable gift annuities, and I'd like to let you just to think about there's different names that are thrown about, and this is important because your donors may ask you quite often, most of the time actually, when a client of mine says, hey, we got a prospect, it's usually the donor comes to them and says, oh, I want an annuity, or I want a charitable annuity, or annuity trust, or you have to be familiar with the different terminologies that are out there. CGA is typically like what we in the plain giving world call it. Gift annuity or charitable gift annuity, or charitable annuity. But when you hit the word charitable annuity, now we're not so clear what does that really mean, because that's technically not the right name, but anyway, that's what it's called. So it's good to know the acronyms and things like that. Now, the other group of life income gifts, the other main group is charitable remainder trusts, CRT, or CRAT, spells CRAT, that A stands for annuity. CRUT, the same thing, but instead of A for annuity, U for unit trust, which again, that's more variable payments. So we're going to talk about the difference between annuities and unit trust, or an annuity trust. So you see, it looks very close to gift annuity. One person may say, I want an annuity trust, or I want a charitable annuity. They may not realize there's actually a pretty big difference. So I'm usually, when I'm talking to clients or people and they're talking to the donors, I say, okay, try to find out what they're really talking about, what they've established. It's good. It's always a good idea to know if a donor comes to you to know what type of other plain gift they've done with other charities. And it's sometimes called a unit trust, or sometimes just called remainder trusts. And there are other acronyms that apply to charitable remainder trusts, but these are the only ones that are relevant for us right now. Now, something called a pooled income fund, and this is the last you're going to hear about a pooled income fund. It is a real planned gift, and it's essentially where individuals, each make their gift to one bunch of pooled gifts, and each donor gets a prorated share of the actual income from the pool. But of course, nowadays, income, meaning interest income, is like nothing. 2.2% or whatever. It'd be basically your donors would be getting nothing out of these pooled income funds. So, I don't even know how they really operate these days. Very few of them are done. These were popular in the 1980s because interest rates were 8, 9, 10%. So a bunch of people could get together and they would just split the interest income among each other, prorated, and there'd be a pool of principal left for the charity. But at this point, most charities that have a pooled income fund are actually looking to sort of let all the donors die and just close it down because there are some administrative headaches associated with running a pooled income fund, and most donors are not interested in it. It's nothing compared to the vehicles that we're going to talk about. Okay, so in terms of common features, it's important. All these are irrevocable gifts. Again, we had talked about a couple sessions ago. I always use that to chart the revocable stuff, all the bequests, things like that. Those are all revocable until you die, of course. These are irrevocable gifts. Important. Remember, regarding all of them, donors cannot take back the money if they're upset with you. They all involve some sort of fixed income stream to donor. I'm using that in a general term because sometimes fixed means the actual same amount each year. Sometimes it's a percentage of the value in the trust, which we'll talk about in a little bit. And they're always talking about either income, usually for 1 or 2 lives, and sometimes, depending on the vehicle, for a term up to 20 years. Again, we'll get into the details later. And we're almost always talking about older prospects. I'd say 60 and up, and that's 60 is pretty young at this point, 70s and up. But of course, we'll cover some of the examples for potential younger donors towards the end. But usually, practically speaking, most of the plan gifts that are done these days are people who are old enough, in their 70s and older. Okay, so let's we're just looking at the things that are the same. Tax benefits are all the same. There's always a charitable income tax deduction. I like to say it ranges between 20 and 50% of the value of whatever you're giving. You'll see that as we go through the illustrations a little bit. So it's not somebody gives $100,000 to fund one of these life income vehicles, they're going to get a $20,000 or $30,000 deduction, maybe $40,000 or $50,000. That's usually the deduction, up to approximately up to half of the value. Again, depends on the vehicle, depends on the age of the donor, the income beneficiaries. And then we talked about last week capital gains. So capital gains is not taxed at the time of the gifting. Again, this applies to all these. That's important. I worded it very carefully because that implies that there might be some tax at some point of the capital gains, but not at the time of the gifting. That's important to know. And then what happens to the capital gains that's avoided, it depends on the particular structure. But generally, even though some of these may involve a donor actually paying capital gains in time because they're getting payments, and some of the capital gains may be attached to those payments, but that's not the same as having to sell a property and writing a check to the government. So there's capital gains avoidance, at least at the time of funding the gift. And even though it may show up later in the gift, it's not a deal breaker. It's still good on playing game. Capital gains avoidance is clearly a big incentive for these gifts. It's probably the biggest incentive. Now, estate tax avoidance is not a big issue for most people, but it is there. Again, there are a couple exceptions depending on if you're involving gifts that if you want to create an income stream for a child, for say, and that's one of our last examples. I'll mention there that the exception. State tax exception there's an exception to the rule of state tax avoidance. Okay, and let's just quit. And this is typical of the process that almost all these things go through. You have some conversations. Usually the donors are initiating them. I mean, it'd be nice if we, the fundraisers, you guys out there, are hey, this is something you might want to think about, and that's something for you to work about. But most of the time, donors are saying, hey, I've done this with another charity, or this I heard about this, or I saw an advertisement. So you have some conversations, figure out what they're really looking for, try to hone in on what they may have done with somebody else, or what they might be interested in, and try to come up with some illustrations and proposals. I use PG Calc software. There's Crescendo, a couple other companies out there, but usually we're using the software I customize things as much as possible, but in any case, you have these illustrations, try to show the donors what the benefits will be. And sometimes in negotiations, the negotiations really depends on the vehicle involved, and that's one thing we'll keep our eye out as we go through today. And of course, at some point, donor wants to make the gift. There's an actual agreement in any of these cases that the donor signs, and the funds get transferred, hopefully to a bank that is managing this and making the payments on your behalf to those donors. Again, that's a typical process. All right, so I wanted to get to gift annuities pretty quickly. So gift annuities are very important. Your organization may not issue gift annuities right now, and they may never issue gift annuities, but this is something for you to think about. It is one of the biggest challenges in plan giving is that gift annuities, it's the rave of plan giving. That's really for the last 15 to 20 years, gift annuities, everyone's got to get into gift annuities. But at the end of the day, it's not so simple to be issuing gift annuities. So it's a big challenge. What is a gift annuity? It's a contract. It is a simple contract between a donor and an organization. There are standardized rates based on the ages of donors. Now, most charities will use what's called the American Council on Gift Annuity Rates, ACGA. Standardized rates, they use an actuarial firm to figure out what are the appropriate rates to payment rates to issue these annuities to your donors. It's basically an annuity product. If you know anything about insurance, there's something called a single payment life annuity. This is basically single payment life annuity being issued by a charity. So it is really an insurance product. Don't get nervous about that, but it is an insurance product. The rates, which are designed again by an actuarial firm that does this for the ACGA, and hopefully your charity will utilize them. And this is something just to keep in mind. Now, the rates are designed to produce what's called a 50% remainder. Now, that means that if you add up all the numbers, you add up the life expectancy tables and some investment assumptions, which is what's called the AFR, the discount rate, and if we put this money in the bank and it's going to earn the discount rate, which is like 2%, and we're going to pay this donor 5%, at the end of their life expectancy, 14, 15 years, whatever the charts say, the life expectancy, on paper, at the start of this gift, there should be 50% of the initial gift there at the end of the life expectancy of the donor. Now, actually, that's not if that were the full picture of gift annuities, that would actually be not the best picture, because it could be 15, 20 years away, the exact same dollar amounts. There's no inflation really taking into account here. So $100,000 gift today at the end of life expectancy, only $50,000 left over. That's not, after 15 or 20 years, that's not the most exciting thing. But this is like sort of a theoretical calculation, and that's basically what state departments of insurance generally require, and this is for the most part across the country. Each department of insurance can do what they want, but they basically all do the same thing. They all require that if you're going to issue these annuities and you're going to be exempt from insurance laws, or you're going to have to follow, whatever your state requires you to follow, that they want at least the rates to be designed to at least meet this. Meaning, the states want to make sure that there's a good deal for the donors, but it's safe for the charities and also safe for the donors. So this doesn't mean that every gift is only going to be half of it left when the donor dies. That's not true. Could be more, could be less. Really depends on how it's invested. But this is just sort of how these are done. It's just important to know that's the rule by gift annuities. Now, gift annuities, it's important to know that when you see the word annuity, it always means fixed annual payments for life. That's really what an annuity is, and that's what gift annuities. That's basically what they are. There are a couple things we'll touch upon at the end, but the concept generally for gift annuity is fixed annual payments for life, 1 or 2 lives. That's the rule. In terms of flexibility, that's not so flexible, because as we'll see by charitable remainder trusts, charitable remainder trusts offer what's called term of years, or even charitable remainder trusts could offer things beyond 2 lives, which gets very complex and doesn't happen very often. Of course, there's the same thing again for all these for annuities, and I'll say this a couple times. Of course, after the passing of the income recipients, the money is freed up for charitable purposes. I mean, technically, if there were no departments of insurance overseeing gift annuities, you could spend the money right away and just pay the donor what you owe them. But most departments of insurance, to have any involvement in gift annuities, want you to hold the money. So the sane way to handle your gift annuity program is to just hold the money for as long as the donor's alive. Obviously, your bank or somebody's got to keep track of each donor's share of your pooled account. Gift annuities are always invested in a pool, so you invest all the 10, 20 annuitants, all the money goes in one pool. Somebody's got to keep track of each annuitant's share, and then when they die, you remove all that or part of that, and that's how these things work. And this has become the standard plan giving offering, but the caveat is, depending on the state you live in, you might have some hurdles to overcome in terms of licensing or other hurdles. If you write down, it doesn't say anywhere in the presentation, but ACGA, the American Council of Gift Annuities, if you go to their website, besides the fact that they'll give you the current rates that they're recommending, again, in theory you don't have to use them, but you'd be nuts not to use them. They also have on their website all the different state regulations. So you just want to double check to see if you're in a state, or you may be dealing with donors in states that are highly regulated. You'll want to know that. So as much as gift annuities are a standard plan giving offering, if you're in a state that requires heavy regulation, New York State, I know there's some New York State charities on this call, you have to really think this through, and you have to do a lot of work before you start issuing gift annuities. So it's a standard, but it's not so simple to get into the business, and sometimes you're forced to look for other umbrella organizations or community foundations that may actually issue gift annuities on your behalf and hold the money and handle everything, and the remainder either gets sent to you or stays in a fund at a foundation, something like that. So this is something to understand, that your charity may never be able to actually issue gift annuities for this and a lot of other reasons. Big challenges in getting these programs going. Okay, so some of the unique things about gift annuities, and this is why it's hard if you can't offer them. It's upsetting. They're generally very easy for donors to understand. It's a pretty simple program, and that's one of the reasons we tout gift annuities. The minimum gift, now I say the minimum gift starts around $5,000. I've always operated on that in my career. I started full-time in plan giving in 1998 with the Anti-Defamation League, and we had to create I basically had to get their programs licensed in a couple states, in New York State where we were incorporated, and we always did 5,000 above. But a lot of charities like to promote from 10,000 or above. One of my clients is 25,000 or 50,000. But really, gift annuities you can do as low as 5,000. You can go lower if you want, but at a certain point you're wondering why you're spending all this time. I felt 5,000 is a sort of a good number that donors feel comfortable. Some donors that's their giving level. They're never going to write a check more than $5,000, and gift annuity for $5,000 is a nice gift for them, and they might do multiple gifts. So I like, and that's important because you'll see the other charitable mandate trust does not, much higher threshold. Unique about charitable gift annuities, the contract is there's no need for the donor's attorney to review it. Of course, you should always put caveats in your letter. Always encourage donors in any plan giving situation to have attorneys and other advisors have them bring that to them. But you really don't need it in a gift annuity, as we'll get to charitable mandate trust. That is the opposite by charitable mandate trusts. So charitable gift annuity, there's 1 to 2 page, easy contract. In fact, I utilize the templates that are built into PG Calc software. So if you have the software, you've got templates, print them out. Obviously, your state that you live in may have some little things here and there. New York State, of course, makes you change things. But it's so easy to pop out these contracts. I mean, I could put together a gift annuity contract in 5 to 10 minutes, reviewed and ready to go, emailed, and just print it and have a donor sign it. Now, in regard to the gift annuity, we're talking. I say it's unique that, basically almost always talking cash or marketable securities. Now, New York State, for example, which is like the big, one of the major states in terms of licensing issues, they used to not allow anything but cash or marketable securities, but they've actually opened it up to other things. But I'm just telling you, if you're going to get in this business of gift annuities, only for gift annuities, stick with cash or marketable securities. Don't just stay away from illiquid stuff, meaning real estate or collectibles. Do not get involved in that for gift annuities. It's just not worth the risk. It's just a bad idea. Another thing about gift annuities, each year the donor is receiving payments from you, so there has to be some tax reporting. So the donor gets a 1099 To in the 1099, we'll see in a second illustration, how the income is broken down per year for the donor. It's a very simple form. Looks like you get same thing for bank interest. Very, very similar. And if you actually add up all the financial benefits to the donor, gift annuities are clearly the best deal. It's not that way in terms of if you're looking for the charity, that's not always the case. But for the donor, gift annuities are the best deal financially, dollar for dollar, as you'll see in a second why. And it's supposed to be easy for charities to issue and administer, but of course it's totally not true. Especially if you don't even have a gift annuity program started, it's a huge hassle, and it's much easier to just do a charter remainder trust, which we'll talk about in a second. But in any case, that's how they're touted. Once you have an established program, it is really easy to issue them and administer them. But you've got to get yourself established. You've got to get a bank managing it. A lot of steps that have to go in before you'll actually have a gift annuity program set up. And here's and then again back to PG Calc, but again I customize this a little bit. Illustration, our same picture, but now we put some cash and the age of the donor here. And so we have I think I use age 72 and 74 back and forth. So this is a 72-year-old comes to you, a $10,000 cash gift, a check for $10,000. The chart says 5.4% is what that person is entitled to for the rest of their life. And they're going to get well, let's skip to the payments. So they're going to get $540 a year, 5.4% of 10,000, easy math. And I put in red 423 of which tax free. So that is where charitable gift annuities is really a great deal for the donors. You're going to when you get the next trust, the charitable remainder trust, we do not have any guarantee of tax free income. So this is a good deal. This is and I'll show you in the next slide or two, the value of this income stream, because it's definitely worth more than $540 a year because there's a lot of tax-free income there. And of course, the deduction here in this case on 10,000, 38%, 38.7% or $3,870. Again, that's what I predicted. That's typical deduction, typical range at least. And it's just note here again. I don't want to go too much details about the complexities of actually creating these calculations because you don't need to know that. But you see here 14.5 years, so tax-free income for 14.5 years. That means that this donor's life expectancy, donor age 72, is only 14.5 years. And so all basically this is a contract for the life of the donor, and there's sort of the $423 per year, sort of what's called return of principal. Then we know that they're going to get a certain amount, assumption of they're getting back the money they've given you, and anything they don't get back is charitable deduction. I actually did a little math before I started this call. If you multiply 423 times 14.5, you come up with let me take a look at my calculator just because I don't want to play around with this. You come up with 6,133.50. Basically, everything you get the deduction on 3,800. Anything that's not deduction, you're actually technically getting back if you live out your life expectancy in the tax-free portion, and actually get more money because you get more than 423. But anyway, you don't have to worry about how these calculations are made. But it's important to note that there's a certain amount of tax-free income, but it ends if the person exceeds their life expectancy. The tax-free ends, and at that point they're on bonus time. So according to the actuarial tables, and here I want to just show you this to you. And again, this is a chart. This is right out of PG Calc. No adjustments. This is a chart I urge you never to show your donors unless your donor's an accountant or somebody. But I want to show it to you for a reason. This is under sort of the second tab. A couple interesting. And there are a couple different versions, different options they have. PG Calc offers. This one is return based on cost of plan. I felt this sort of the most simplest way to look at how valuable this income stream is to this donor. So we have our same facts: donor $10,000 gift, beneficiary age 72. Let's assume that's our donor also. Beneficiary is the income recipient, and the donor. Let's say it's all the same person. Going to get 5.4%. Here's $10,000, 540, 423 tax free, and we've got 3870 is the charitable deduction. Now remember last week, so we said that it depends on the donor's tax bracket. Just multiply times his tax bracket, and that's the actual savings. So this is a higher bracket. So the guy's in the 35% bracket. So he saves. This is a real tax savings of $1,354. So the gift did not cost him $10,000 because he got a rebate of $1,354, which really means the out-of-pocket cost was only $86.46, according to this illustration. So if you assume $540, divided by 846, which would figure out what the actual rate of return is, would come out to 6.2%, which is, so it's definitely worth more than 5.4%. It's really worth 6.2% if you add in that rebate savings. And then if you add in the tax-free, a little note down here, the tax-free portion, really this is worth equivalent of 8.9% for a fully taxable income stream, which is just something to put in front of you. But there's a little confusion there, and I get a little nervous trying to show this to donors. I had a boss who loved this concept, and we used to send it out to our prospects, but I was not happy with it. I don't think it helps close the gift. I think people get this, they understand it, they get the rate, they're happy with the rate, they're happy with the deduction and avoidance and capital gains if applicable. They don't need to see this sort of little trick here. But it's just showing you that this is a good deal for your donors. Okay, so in terms of the benefits of selling CGAs, again, irrevocable plan gift. That is important. Even though we know bequest dollars will be the big portion of money that your organization receives, there's something to be said to a gift that's a real done deal and the check's been written. And there's a lot of benefits, not just that you've got the gift, but there's something that your leadership sees real money in the bank. For some of my clients, I wish they had these because it would make a big difference. If they had gift annuities coming in, they have cash being invested, they would take the program a lot more seriously. And here's the key thing with gift annuities, because you could make the case that, I told you about that 50% remainder, and that doesn't sound that exciting, and we could even get a lot less than that if we don't handle this properly. Bottom line is that you have an opportunity for lifetime connections with these donors, and this is important. If they get paid on time, they're very happy with their payments. Even if you might think, wait a second, our example is $540, and that's like what, 133 or 100, some real small quarterly payment, but they love it. And these are people who appreciate getting their checks or direct deposits on time, and they could, these consistent touch points. If you do it right, you're going to get more plan gifts. Now, you might get a lot of donors. Every gift annuity program I've ever looked at has donors who do multiple gift annuities, and that's a definite bonus. But the more important one, I'll tell you, a really large gift annuity program that I'm friendly with, I've advised as a friend over the years, and we've talked about how they do in gift annuities. They have over $50 million in gift annuities. They could do 100 to 200 annuities a year. They admitted to me that they checked out the remainders, how much money they get, on average when someone dies based on the original gift. It was only 20 to 30%, which is very low. I mean, somebody gave them $100,000 20 years ago, and they get $20,000 when the person dies. And they said the reason was that their donors live a really long life. There's something in the water for this organization's donor base. But they also calculated how much bequest dollars would come into their plan giving program each year from annuity donors, and it was millions upon millions of dollars. So there are a lot of benefits of selling CGAs. I call it selling because it really is like a product. It's a lot of benefits here. Again, feeder for bequests and other plan gifts, and that's really, really crucial. And another challenge I find is that it's hard to go out there and say you do plan giving, but we don't offer CGAs. It's a challenge. You could do it, but if you're going to do a full plan giving marketing program, you'd like to be able to say we offer everything everybody else offers. That's okay. So a couple quick takeaways before we get on to charitable remainder trusts. So gift annuities, they are the most well-known plan giving vehicle besides bequests, for better or for worse. They are supposed to be easy to understand, easy to set up, but really, in reality, they're really not so easy. Usually talking older prospects, women in their early 70s tend to be supposedly our best prospects, and it's good for a donor who likes the concept of increasing income, get a nice charitable deduction. It sort of enables them to make a gift they wouldn't have normally made, and you get the positive lifetime connections is probably the most important point, because you can really bring in significant, very, very significant bequests and other gifts with your happy gift annuity donors. And again, feeder for bequests and other plan gifts. Okay, take a quick breath and sip of coffee. Now we're going to change directions again. I know I'm throwing a lot at you. Now we're going to talk about CRTs, charitable remainder trusts. And I'm going to keep going back and referring back to charitable gift annuities to help us understand charitable remainder trusts because they're very, very similar, but they're also very different. And this is, again, back to our PG Calc little chart here. Again, I didn't change anything on this aspect. Donor puts something into the donor, usually money, usually cash or securities, but could be something else, into our CRT now, charitable remainder trust. And again, income payments, fixed income tax deduction, remainder, nothing new in that chart. So what's common with all CRTs? Now, CRTs, I already hinted you, there's a lot of versions of CRTs, and CRTs offer a lot more flexibility, interestingly enough, than the CGAs. So what are the common features? So that we're, again, always an irrevocable gift, always some sort of fixed income stream to donor, but there might be some variables there, we mentioned already. Could be 1 or 2 lives or a term of years. Again, term of years is definitely a distinguishing feature for CRTs, but there are a bunch of other distinguishing features. Almost always older prospects, but again, if we can do a term of years, then a younger donor could do it because, again, we're just not doing it for a 50-year trust and never pass any of the IRS tests. We could do, a donor in their 40s or 50s could do a 15-year charitable remainder trust, 20-year trust, not more than 20-year term. But that's so you could have younger donors if they're willing to take a term of years trust. Some charities, that's all they offer. They charitable remainder trusts are always terms of years. Helps the charity know when these things are going to end. If you're talking about a 2-life income option, again, usually we're talking spouses, but again, could be a parent, a child, could be a donor creating up a charitable remainder trust for friends of his. I mean, all this stuff creates complications, which I'm not going to go into right now. So if it's spouses, no complications. That's typically what we're talking about. Now, what is a CRT? Now, I should make this bold. It's a trust. A trust. Now, trust really is a contract between a trustee and a donor, but a trust is it's like a corporation. It's like every state has their corporation laws. Every state has their trust laws. Now, trust came out of common law and out of common law cases. Eventually, states actually have specific laws on governing their trusts created in their states. But it's a trust. It's an entity. Obviously, it has to be qualified to become a charitable remainder trust. Though, has to meet some rules, which is again here mentioned IRS. So there are a bunch of IRS rules. Now, the rates for CRTs, they're negotiable, but there are IRS rules. I'll probably mention it later on. Just the minimum, one of the rules IRS has. Again, you have to follow the IRS rules to get the stamp of approval to be a charitable remainder trust, as opposed to just a regular old trust. Makes a big difference because then if it's not a charitable remainder trust, there's no income tax deduction, and then there's no other tax benefits that a charitable remainder trust has regarding the IRS. So minimum payments got to be at least 5%. So any of these charitable remainder trusts, any of the versions, it can never go below 5%. I already showed you examples of charitable gift annuity where 4.7%. Charitable gift annuity can go whatever the rate table says it is. So you don't have a minimum issue. You can always go lower than 5%, but not with CRTs. CRTs have to have a 5% payment. And then there are IRS rules, other rules regarding the remainders, a 5% rule, a 10% rule. I don't want to get into the details. The rules, basically, when you put the calculations into the computer, it'll tell you if the trust is not doable because it violates one of the IRS rules. It'll just tell you. And again, but the message is you have to have, before you do any charitable remainder trust or gift annuity, for the same reason, you've got to run an illustration under one of these software programs because someone's got to run it for you because it may actually fail tests. There was a case I dealt with years ago where 2 charitable remainder trusts were set up and for the same donors, and they the director at the time, somebody who I knew, but he was a little sloppy. Never put the information into the computer. Just created the trust, took the money. It was $100,000 gifts. Turns out they failed the tests. So you'll know the test. You know you're failing the test when you put the numbers into PG Calc or Crescendo or whatever you use, and they'll tell you, "Oops, you fail." Now, charitable remainder trust different than charitable gift annuities. We're usually trying to picture 100% remainder. Not this 50% end of life expectancy. Somebody gives you $100,000, treat it like a $100,000 gift, and we hope that it'll be more than $100,000 after the end of the trust. Now we know realistically that's not always the case, but that's how CRT should be viewed. And again, that's obviously you can start thinking that's better for our organization because we're not giving away half the principal. Hopefully 100% or more will be there. Now, the two main types of charter member trusts, they have ones that pay fixed annual amounts. That's just like our gift annuity. Again, the word has the word annuity in it. It's a CRAT, Charter Member Annuity Trust. That means that the payments annually are going to be fixed. Or we have these variable payments. Now, variable varies from year to year. A fixed percentage of the annual value as of January 1st each year. So when you have the second one, the CRUT, and if you by the way, if you went on my call a week and a half ago, the free call I offered everybody, there are a lot more CRUTs in the world than CRATs. So that's a question you want to think about. Wait a second. Why would there be a lot more of these more complex things that have to be revalued each year on January 1st to figure out what the donor is entitled to? A lot of room for mistakes, but there are a lot more of them, and I'll hint to later on why that is. Remaining, again, after the donor dies, again, the trust now has to, the income after income recipients obviously have to pass away. The trust is dissolved. Charity gets its funds again. Now, charter member trusts were really the standard plan giving offering in the 1990s before gift annuities took off. A lot of it was driven by the avoidance of capital gains. A lot of particularly the financial planning world. Again, that's what I was hinting to. Why there's a lot more CRUTs out there. Financial planning world got a hold of these things and promoted them pretty heavily among their clients. So, and I guess one of the features of a charter member trust, which just to let you know, I mentioned already gift annuities. You have a pooled fund. The charity manages its pooled annuity fund. But charter member trust, each one is a separate account. In theory, I think we'll say I say it here. We'll say it in a second. In theory, the investment advisor could somehow be of the donor could still be managing those monies. So that's one of the reasons why they were pushing with charter member unit trusts. I'll show you that and why that was the case. It's because the professional advisor world benefit themselves out of this because they get the donors could avoid capital gains and they could still manage the money after the stock has been liquidated. But again, jumping a little too fast here. A couple unique characteristics. Okay, so charter member trust, we're talking about $100,000. So that's a big difference between minimum of $5,000 to $10,000. Now we're talking $100,000. And for years I've heard colleagues say even $100,000 is low for charter member trust. Now, I think $100,000 is pretty good minimum. If someone said, well, we've got a donor and he's offering us $75,000 and we can't do the charitable gift annuity because our board won't let us or for whatever reason, how about charter member trust? So, okay, 75, I'd go that low. Get down to 50,000, yeah, could if the terms are favorable to the charity, great. But at a certain point, it's like not worth it because there are annual costs in managing each trust is its own entity. It has its own tax identification number, has to do its own annual tax return. Now your banks will do all this stuff for you, but someone's going to pay for that tax return. It's not $500, maybe $700 a year, but that starts adding up in terms of costs. And at a certain point, it's just not worth doing charitable member trust for a lower amount. Particularly, $100,000 is a good starting place for charitable member trust. Now, again, we mentioned already the rates are not standardized and negotiated. Again, minimum payment 5%, 5 to 10 page trust document. This is really important. The donor's attorney has got to be involved in this. I mean, preferably your donor's attorney should draft it. Of course, that creates another set of problems. What if they screw up the drafting of trust? But in any case, you've got to at minimum have a donor looking at this trust. It's very different than a gift annuity. So that's a big difference. To get a gift annuity done quickly, donor just says, here's your money. Boom, bing, bang, boom, we're done in a day or two. Charter member trust, you got to get an attorney. It's got to draft that trust. You cannot be drafting this by in-house staff. That's for sure. If you do that, you really it's a mistake. You have to have somebody's got to have outside counsel drafting it. If your charity is the trustee and the actual manager of the money takes the fiduciary responsibility over this thing, over this trust, then you can have your own attorney draft the charter member trust. But you always have to have a donor review, and that's you got to, or if not, you have to have them sign off on a piece of paper saying, yeah, we've been warned to have a donor review it. It's because it's basically equivalent to like their will, and courts do not look favorably on even charitable organizations drafting legal documents on behalf of their donors, which obviously usually cuts family out of the picture. So they don't. That's something to be cognizant of. Now, charter member trust are typically funded with liquid assets, again, cash, marketable securities, but also illiquid assets, real estate, art, tangible property. Important to just keep that in mind. So that's one of the big differences with chattel managed trust also. So if there's something unusual, we can find a version. There's different versions of chattel managed trust, of course. We can find a version to handle real estate or art or tangible property. Not the case with gift annuities, which you want to avoid at all costs. Now, the tax, instead of a 1099 like the gift annuities, chattel managed trust issues what's called a K1. There's a tax return, a full tax return, and then there's an extra piece of paper called the K1. Donors get to see it. One of the challenges is, and I haven't looked at a K1 in a couple of years, but I recall that if the donor is smart, he can look at the K1, he sees how much income he received, what he knew he was going to get that income, hopefully, and he sees how much is taxable. And there's a different rate, if there's any ordinary income in the trust investments, it flows out to it shows up on his K1. He owes, part of the income that he's receiving will be what's called ordinary income, those highest tax brackets that we talked about last week. If there are any capital gains in the trust, again, looking at the trust itself as like a separate entity, the donor might be paying capital gains. If there were any avoided capital gains when the donor created the trust, then those might also show up on the K1. Again, if you're the income recipient and you're getting, let's say, $10,000 from your chattel managed trust, your K1 will say, $3,000 is ordinary income and $7,000 is capital gains. In theory, you could have what's called tax-free income showing up on the K1, but very unlikely, unless the trust is losing money, and whatever. I don't want to even go into it because it's not worth it at this point. We don't design chattel managed trusts to be tax-free income payment options. So one of the challenges I find with these chattel managed trusts is if the donor looks at the K1, I believe they can see how much assets are left in the chattel managed trust, and donors get a little annoyed, even though it doesn't affect their payments usually or whatever. They don't like to see the trust losing money. Sometimes the trusts are losing money, so you're revealing quite a bit to your income beneficiaries each year by sending them the K1. That's what I believe. I haven't looked at it in a couple of years. Again, finally, I've alluded to this already, and this is key for chattel managed trust because it's a separate entity. You could have a bank managing it. You, the charity, could be the manager, the trustee, depending on your state law, by the way. You got to ask a lawyer that, depending on what state you're in. Or the donor, or a combination of the two, could administer it. Now, this is important. This is a big point I'm making here, and this is one of the reasons why there were like 80 or 90,000 chattel managed unit trusts in existence, more than like 4 times as many than the chattel managed annuity trusts out there, because banks love to manage these things, and or donors can manage them themselves with their investment manager still continue to make money off the account because it went from donor's personal account now to the chattel managed trust account. These are a lot of options here. I think what's important for you if you start off plan giving program, which a lot of people on the call, that seems to be where you're all coming from. If a donor came to you and said they're ready to do something and it's close enough to the $100,000 level, you go to your bank and just say, hey, we've got a donor ready to a chattel managed trust, and you sit down with your bank, and the bank may recommend just having the bank be the trustee, or the bank has some banks, TIAA-CREF and others, they'll have a deal where you sort of co-trustee. They'll guide you through it. So you want to find your banks. Some of the big banks, TIAA-CREF is obviously they have connections to they're big in this. Obviously, State Street Bank is one of the biggest. Mellon is also huge, and for smaller charities that do this, they might go to PNC Bank has an excellent program for excellent options for programs that are around $1 million. So there's a lot. You have to do research. Some local banks might handle this. So chattel managed trust, and one of the nice things about chattel managed trust is typical banks and trust companies all handle these things. That's actually different than gift annuities. So gift annuities, which was our previous option that we discussed, gift annuities have a limit that not that many banks actually know what they're doing with them. So you could have a donor here, visiting you tomorrow, and you could be having a chattel managed trust conversation, and you can get it set up without even an official plan giving program in place. Okay, so just to talk about a couple of the differences, we talked about a chattel managed annuity trust. I called it a CRAT. I'm sorry, I keep playing around with these terms, but I want to get you acclimated to them. So donor, it looks very much like a gift annuity, very, very similar. So we have a 74-year-old donor, $100,000 cash that goes into our CRAT. gets now in this case, and again, these illustrations I did these a while ago. There might be some slight differences here and there, but this is basically to give you an idea. It's not precise date-wise to today's date, but basically this is what you would see. So in this case, donor was 5% payment, flat payment, meaning $5,000 a year for the donor's life, $48,000 deduction, fixed payments $5,000 a year. Nothing too complex there. As you notice, there's no tax-free income here, so this is definitely not as valuable to our donor who is a similar age doing charitable gift annuity. Something to just keep in mind. And now I change it to a charity-made uni trust. Because this is where the payments will change each year. There's a lot more protection for the charity because if the principal of the trust goes down, then the payments to the donor goes down on an annual basis, of course. Again, variable payments starting at $5,000 a year in this example, and then 5% of the new annual value as revalued on January 1st. Again, the deduction went up from $48,000 in the previous slide. Now flip back to $58,000. So a little more protection for the charity. So therefore, the deduction bumps up to 58% of $100,000, which is nice. But that's not a reason why people do charity made unit trusts. They tend to do charity made unit trusts for other reasons, complex reasons. Because I've actually found that donors who got involved again because of the advisor world pushing unit trusts, donors actually tired very quickly of these unit trusts that they set up. There are some advantages to a unit trust. One of the advantages, which I don't think is in writing here, so I'll just tell it to you guys. A big advantage of a charitable made unit trust versus the other versions that we've been talking about is that once somebody creates a unit trust, a donor can always add money to it. So you could fund it with $100,000 this year and add 20, 30, whatever. You can always add money or stock to your unit trust, and you don't have to create a whole new trust. So this is one of the reasons why my original bosses in Plan Giving were so gung-ho on these unit trusts, and they'd have donors make pledges to add, $30,000 a year each year to the unit trust. But what happened would be is that those donors, I'd go visit with them saying, look, how's your trust doing? This is this year's payments, and things would get a little messed up usually, of course. And basically donors get very tired of the payments changing, never knowing what they're really entitled to, and what's coming here, what's going there. So I had a lot of donors who I had some donor situations where a donor would have been started off with a unit trust. After I described to him the options, we switched over to a unit trust for a brand new trust for his next gift. And then I even had the same one case where a donor went from unit trust to an annuity trust to a gift annuity because, again, it just donor liked the simplicity factor as we got our gift annuity program going. So charter unit trusts are popular. His slide just sort of gives this gives a hint of how there's so many charter unit trusts out there in the world. Again, this is just for our unit trusts where the payments change. And this is basically a similar chart that don't look at the 3% return. Look at the 7% return. And so this is an example. If this charter unit trust was paying 5% a year of the value to our donor, was earning 7%, so it's paying out 5%, but it's banking a little extra 2% each year. So each year our donors' payments would go up. By year 10, they'd be earning $6,000. This is nice. Sounds really nice. The reality is that the professional advisors were not showing the donors what would happen if they only earned 3% a year. Because obviously they're losing 2% a year, and the payments be going down, 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 down. And this is just a good example of how unit trusts work. Obviously these are fixed. No, it's never exactly straight lines. It's 1 year it's up, 1 year it's down. One of the challenges in all these things, and what if if it's invested overly aggressively, it could be up 1 year and down the next. So there are a lot of challenges in these things. Just to give you an idea of how they work. Now I mentioned last week real estate. Again, this is part of the program where I'm exposing you to stuff that you may never get to in your plan giving work that you may hopefully be doing. But I mentioned real estate, so let's take a look at a real estate example, and I'm going to show you a real estate example in a couple minutes on the gift annuity side. So let's take something called a charitable remainder flip unit trust. Now I intentionally did not introduce you to all the different terms regarding charitable remainder trusts. There are, but this is an important one because this charitable remainder flip unit trust is designed specifically for things like real estate, which may not be sold for a year or two, could even be tangible property. Stradivarius. I know one of my plan giving colleagues years ago got a Stradivarius, put into charity unit trust and sold it. So, but this for real estate, I'm always directing clients. Somebody has to be real estate. They could put into a charity unit flip unit trust, it's a unit trust. Again, the payment's going to change, but there's a little slightly different rules, which I'll show you in a second. And what happens here? So, step one, I've been working on one of these recently, but I spoke to my client today, and I said, hey, what happened to that flip unit trust that we were working on? I created the trust. I had a donor who was going to give $1 million piece of real estate, and I drafted the trust for them. That was my role. Gift never actually happened. They never actually transferred the real estate. But if the deal is really going through, trust documents finalized, and when the trust documents finalized, by the way, the lawyers, me or whoever, accountants involved, you have a trust document. You go ahead and you get a tax identification number for that trust, and then the name, and you can change the title of the real estate into the name of the trust. And that's exactly how this would work. Then, and when things work nicely, the real estate is sold. Now, during the years up into and including the sale of real estate, again, because it could take a year or two to sell real estate, it doesn't always happen. In those pre-sale years, donor is going to get the lesser of actual income or the unit trust percentage. So we assume most charitable unit trusts these days you set up as 5% for various reasons. So, it was a farm actually property that we were talking about last year for this donor who wanted to contribute, and so there was some actual income that would flow back to her through the charitable unit trust. It wasn't going to be more than 5% of the property value. So whatever income she was actually getting, she would have continued to get had she created this charitable remainder unit trust. But quite often we're talking real estate is usually maybe it's vacant real estate or property that says nobody's in it, so it usually is no income. So when there's no income, donor gets lesser of the actual income or the percentage. So actual income is 0, they get the lesser of, they get 0. And that's fine because we set these things up for the year following the sale of whatever unusual asset is, in this case real estate. In that year following the sale, donors now get that unit trust percentage as of January 1st, and they've got what's called a standard unit trust for the rest of their life. And again, all of it depends really on what you sold the real estate for, which is actually great for the charity because you're not. What's the risk here? If it sells for a lot, you're going to get more at some point. But the donor's income is always based on what's actually in the trust. That's the key part to this particular version of charitable remainder trust. And so let's just finish up charitable gift remainder trusts, and we'll do a couple examples of unusual examples. All right, so benefits, CRTs. Again, I keep talking about this in an irrevocable plan gift. You can't beat that in the plan giving world because sometimes the bosses get tired of hearing about these potential gifts. This is real. We always design them to produce a 100% remainder. That makes us feel a lot better. Again, same concept, positive lifetime connections with your donors. You have an opportunity. Of course, the flip side is you have an opportunity to create negative relationships with your donors if you don't manage these things right well. So you really got to be careful what you're doing, by the way. Trust runs smoothly. Donor does more planned gifts. Again, feeder for bequests and other planned gifts, just like charitable gift annuities. And I would say it's more important these days, particularly startup plan giving programs, to be able to handle CRTs, and they're not that hard to handle because you could go right to your bank. So it's a very important part of your plan giving marketing campaign. And it's the choice of most high net wealth advisors. Again, I keep harping on that, but those guys are really important, and they will bring your donors along. They may convince your donors that this is the right thing to do. So it's important to know that. And actually, advisors they become advocates for the CRTs once they realize, and this is important, that they can keep the funds under their management. I mean, under their, an account at, Merrill Lynch. So your Merrill Lynch broker says, great, we set up the CRT, and then the CRT, whatever you fund it with, goes into another Merrill Lynch account in the tax ID of the tax identification number of the charitable remainder trust, but the advisor continues to manage the funds. Obviously, you want to make sure that they're not investing the funds like they would regular funds, but in any case, this is pretty standard. All right, so challenges. Advisor-driven CRTs, which I'm just touting them. I love advisors. But sometimes they don't know what they're doing, and if they don't consult with you or people like me, sometimes the terms are not good, sometimes the payment rates are too high, or maybe the poor investment choices. If a donor is involved in investing or the donor's investment manager, they don't know what they're doing. They invested in the wrong things. I mean, obviously I get all the horror stories that come to me because that's my job. Legal liability. So I hear so many people say, back to charitable gift annuities. Charitable gift annuities, the liability. Now, I didn't mention it already when I was talking about charitable gift annuities. One of the distinguishing feature of a charitable gift annuity, I hate to jump backwards on you like this, is that your charity owes that money whether the funds under management are there or not. Meaning, so gift annuities, it's a permanent obligation on behalf of the charity to pay the donor, whether as long as the donor's alive. And so one of the nice parts of charitable remainder trusts, at least they're touted this way, is, hey, charitable remainder trust is an entity. It's required to make payments to this donor, but if it runs out of money, it ends, and the charity is not liable to continue to pay. Well, the reality, and this is real. The reality is, if your charitable remainder trust runs out of money, you got big problems if your donor's unhappy, and you're going to be paying money in one way or another. And actually, the liability level of charitable remainder trusts, and I know there should be a Plain Giving director on this call who may be listening to me and wondering, is this really true? I'm just telling you that the liability is a much higher level of liability when it comes to charitable remainder trusts, because charitable remainder trust as a trust, each state has all trust laws and lawyers know how to fight regarding trusts. I'm just telling you big liabilities with charitable remainder trust, and that's a challenge. Even though we think that there's no liability, there's actually bigger liability, and you're talking bigger dollar amounts. So we're talking, once you get to, that's a theory I have, is that the larger the gift, the more attention you better pay to it, because the stakes are higher, and better attorneys are hired to come after you. So there are legal liabilities. I also mentioned the internal finance staff. I hope I don't insult anybody, but they don't always know how to deal with these things. I'm creating, by the way, if you didn't notice, I sent out an email to everybody. Anybody who's taken the Plain Giving Boot Camp, and you guys are now on that list too, a survey. I'm thinking about offering courses for professional advisors. I probably should offer courses for also internal financial staff, which would be a good course. Again, they're really important because if you're going to get involved in these vehicles, they need to know also how to handle them. And again, that's the last question. How do you know which CRTs to manage, for how much, and with whom, which donors? Again, these are challenges. Okay, so CRTs, takeaways. A great option when your donor's investment manager is playing a big role. Again, you have to know when to go with the investment manager's guidance, because if the investment manager is playing a big role in this game, you don't want to turn around saying, hey, donor, why don't you just put it into a gift annuity and cut out your investment manager? Well, that's not a great idea. So you want to know when is the right time to talk about a charitable gift annuity, which cuts our investment manager out of the picture, because they don't get involved in investment of our pool. But it is very good, and most CRTs that I deal with these days there's always heavy involvement of your investment manager. It is a great option for larger life income gifts. So once a gift goes over $100,000, you really should be thinking about a charitable remainder trust anyway, because even though I said how all the liability of CRTs, I say is pretty high level. When you get to large charitable gift annuities, the liability issue is maybe even bigger than CRTs. So you don't want to do $1 million charitable gift annuity, even though the benefits of the donor are amazing. Too risky for your charity. You're taking on a liability of payments for life. It's very risky. So as you get into larger life income gifts, you do want to look at CRTs. And it's really the only practical life income gift option for unusual assets like real estate and art. And in terms of CRTs, I could not cover. My professional advisor course, which I'm working on now. We're going to cover charitable remainder trust in 2 separate sessions. So this is like half hour in charitable remainder trust in this course, but in the professional advisor course, it's going to be 2 hours, and that's not going to be enough time. But there's a lot more flexibility for your wealthier donors. Again, it makes a lot more sense, and they can be less risky than gift annuities. Again, if we handle it properly. Okay, so let's see what time it is. It's 1 o'clock. Well, you know what? I'm going to continue on here, and I'm going to spend another 15 minutes. If you want to, you'll get the copies of recordings through the YouTube link or the downloadable link. So if you want to jump off, fine. But I see there's still 12 people on the call, so I'm going to continue and cover these case studies, and you can check them out. If you have to leave the call at 1 o'clock, that's fine. But again, part of the Plain Giving Boot Camp is sort of try to expose you to a lot of the different things out there. I just wanted to get you a good feel for Plain Giving and the vehicles. And just a couple case studies I did with a client of mine, some internal training programs. So case study number 1, again, we're flipping back to our gift annuity realm. There's something called a deferred gift annuity. Again, I was just telling you the plain vanilla, but there is a deferred gift annuity. So what is it? And there's something called a flexible gift annuity. It's a type of deferred annuity, but it's flexible. We'll talk about that in a second. I'll just touch on parent-to-child issues. Sometimes a parent wants to create an annuity for their child or vice versa. And then lastly, we'll talk a little bit about real estate again, and this concept of can we use real estate for a charitable gift annuity as opposed to I was just telling you they have to go into flip remainder trust, charitable remainder flip unit trust, yet here I am talking about for CGA. So we'll talk about that a little bit, a couple takeaways. Okay, these are some real cases that my client actually dealt with. I didn't deal directly with these things. They just described them to me, and we put them into our presentation. So they had a donor, age 59, too young for an immediate annuity. Most gift annuity programs do not like to issue gift annuities for donors under age 65 or even under age 70. So 59 is definitely too young. Now, Audubon, this was the client of mine, their minimum was age 65 and if it's two people, they had to have at least one age 65, one close to 65. Again, it's not a hard and fast rule, but again, we want to keep out our younger donors, basically. But this donor is very serious about doing a gift annuity, but too young to get immediate payments, but was willing to wait 6 years, and we'll talk about that. So this is the picture again, right? This is literally copied and pasted right from PG Calc. Thank you, PG Calc. And this is show for a picture similar to all the life income gift pictures, but now it's called a deferred gift annuity. It's going to be a deferral before the donor starts receiving the payments. And let's just get to the important slide. All right, so this is another option in PG Calc. We put in, it's called, I forgot the comparison, comparing three different options. So again, if this donor is age 59, now if we were willing to issue her actual own gift annuity, her rate would have been 4.3%, and her deduction would have been $2,800. She would have got $430 a year for tax free, blah blah blah, all the same. Of course, we were not willing to do that. Now, what if she was willing to wait to age 70? Now, if she's willing to wait age 70, she gets a higher deduction, $4,500, almost a double the immediate annuity deduction, which is pretty impressive. And her payments are much higher. She would be getting at age 70, she would now get the 7.2%, $720 a year for her life, starting at that point, and lots of tax-free income and lots of good things. But age 70, 59, that's an 11-year deferral. That's a long deferral. Donors, I've never seen donors do such a long deferral. I've done only a handful of deferred gift annuities my entire career, and they're always pretty short deferrals. But what she did she did agree that she would be willing to start payments at age 65, which is a 6-year deferral, a pretty decent deferral. A little higher payment. She's now getting 5.7% starting at that age 65, and this is a deferred gift annuity. Again, this was just right out of PG Calc. We're now putting the numbers in here, and take this is. You can look at this later on. Nothing too difficult here. In this case, her payments are going to start in 2020, and she's going to get a higher payment of $570 a year for life, and she's going to get her tax-free, $320 tax-free out of the $570 for 19.9 years. Pretty nice deal. All right, so what was our takeaway on this one? Here's the challenge, and this is why deferred gift annuities are important. We do have donors in their 50s and 60s, and it's pretty hard to say, well, we can't talk plain giving. We're going to talk bequest or whatever. You want to have something to discuss with your donors, and sometimes your donors want to see these illustrations. Not that they'll do it, but good. So it's good to have a deferred gift annuity option as if you're going to have a gift annuity program. We always talk about supplementing income, investing in Audubon's future, receive income tax deduction today, which is a real value. So your donor gets a deduction up front, which is really a nice bonus. And they get increased income later in years when they need it. These are a lot of really nice points, but the irony is we rarely see very many deferred gift annuities happen. That's the truth. But it does look like a pretty good deal. And here's my big point. If the donors don't need that income when they hit the right age, they could just say, you know what, I don't need the income now, and they can become a new gifted institution. So that's a cool option, which I have implemented a couple times. Okay, so I want to talk about flexible gift annuity. We're not going to cover all the cool things that gift annuities could do, but somebody came up with this, and the government seems to have agreed to this. This is this was a donor, and this is just a case study. She was age 64. She was doing all these flexible and deferred. The flexible is a type of deferred, but these different types of annuities since age 50. So this was a very person does a lot of these things. Each year she just does a new one, between $10,000 and $30,000 or so. And she even did an immediate annuity for her mother, which we'll talk about that consequence in a second, age 87. her face value of all of her gifts, by the way, and this is just one real individual, she exceeded 300,000. So she was doing these things in different increments, but it adds up after a while. So she got a lot of money in play here with Audubon, and she didn't restrict the remainder, which is a good thing. And this is again back to our comparison of different options for her. So if she did she's age 64, so she's really old enough. She's really close enough to do a immediate gift annuity. 4.6% would have been her payment rate. That's would have been her numbers were there. Now, what if she said, listen, her rule is 65, make her wait a year. So she'd have to wait. She'd get 4.8%. She'd wait a year to start getting payments, get a little higher payment, a little higher deduction, a little higher tax-free. Not a huge difference here. Now, what about this flexible annuity? What is this? So we don't know the payment rate because we'll see in a second what that means. Her deduction's the same as if she waited to age 65, so there's no benefits there. Payments, the rest are the same. And this is what she chose. So this is the coolest thing. And sadly, this thing really hasn't taken off, but this is such a great option. And I'll extol this a little more in a second. So let's say she's age 64. Her contract gives her the option. And again, the contract comes right out of Peachy Calc, so you don't have to worry about the cost of drafting a contract. You might want your own counsel to review this, and depending on the state you're in, your state departments of insurance might want to review these things. That's what New Jersey, for example, used to do, and I've done a couple of these with New Jersey. So she's got to wait at least a year. It's a deferred gift annuity. But starting at age 65, she could say, okay, I'm ready to take my income stream. Fine, she's entitled to that 4.8% illustration. What if she wants to wait to age 68? Each year she gets entitled to a higher payment rate. As long as she defers, again, she just has to let the charity know this is the year she wants her annuity, and then you'll just look at the age at that point, and this is her payment rate. And it's actually built into the contract, these rates of payments. Again, she has a choice. And in fact, I created the illustration, and I guess this would all be built into the contract. She could wait till she's age 80. At that point, she'd be getting, let's say 81, she'd be getting $1,200 a year for the rest of her life at that point. So this is really nice. Again, this is the breakdown between, flip back, breakdown tax-free. This is the first column, and then the next column is ordinary income. So she could be getting a really nice payment from this. Why I love these things is, well, let's talk about the benefits here. Huge flexibility to the donors. I mean, I had a lot of situations in Plain Giving where donors say, hey, we're not sure what to do with this money. We might need some of it later. What can we do with you? So this is a perfect example of create the flexible gift annuity, get a upfront deduction, not for 100%, but a decent amount of it, 30 or 40% of it might get a deduction. And then at some point in the future, you'll let us know when you want the income stream. But if you don't need the income stream, you may never take it, and we'll just keep growing the funds, and at some point it'll be transferred to us as a huge gift. So a lot of flexibility here. Again, if they're not sure they're going to need the income, this is perfect. Or they like the idea of waiting and increasing their income. And here, in this particular case, once somebody's done one plan gift, the likelihood of more plan gifts is just much higher than the rest of the population. Okay, so let's again. I don't want to go past 1:15, so I got 7 more minutes. Stick with me here. Okay, parent to child. Just wanted to make a couple points here. This was a real case. I've had these cases in other circumstances. 90-year-old says, I want to do an annuity for my child who's 65. Now, we don't really like this because we'd rather just do it on themselves, and we'll get the money a lot quicker, but this is what the donor wanted, and this is what the donor got. Donor created the annuity. Donor's 90 years old, but the annuitant is 65. So it's the payment rate is going to be based on the annuitant, 4.7% on $10,000. I just use that as a round number. Again, back to our deduction, similar to the other deduction, 34% or so, 35% of it is deductible, $470. That's our illustration. Deduction went to the donor, not to the 65-year-old, but the 90-year-old. Income goes to the younger one, the 65-year-old, and again, tax-free income to our annuitant. And what about, let's flip it around. Oh, no, here's another option. What if we do a two-lifer, donor age 90, and so this is just reduced the payment rate a little bit, and the deduction gets reduced a little bit. So this is really 2 lives. As the 90-year-old gets the income as long as they're alive, and then when they die, the 65-year-old gets the income. There's a little bit of there's a potential tax, gift tax reporting, because it's really an intergenerational gift between the two, but there's a lot of tricks to avoid that. So something for the advanced plan giving program that I'll hopefully be offering at some point in the future. Again, tax-free income 20.1 years. And what was this? Oh, what if we would much prefer the donor just do it on themselves, a 90-year-old, and And let's say maybe our 65-year-old child creates the annuity for the parent. That was what I want to show here. So again, the donor, 65-year-old, gets this deduction, nice deduction. In this case, 62%, getting pretty high deduction here. The annuity goes to the mom. She's in a home or something. She gets her $900 a year, and that was the idea. The key is you don't want to let donors think that they can do this too much for anybody younger than age 65 or around that age. And parent to child, again, I mentioned there might be some tax consequences here, but we always want to push for that older parent to create their own legacy gift and not let. And I've had a lot of donors over the years come to me, somehow get to me, and they're like, they really want to take care of their children. It's usually better to take care of your children with other vehicles and then do the plan gift for your legacy gift to the institution. That's what we hope to see. And yeah, we'd rather parent does their own CGA or request and take care of the children in other ways. But it could work. Might be, and there might be some deferred annuities. It can be done. All right, so we're on the last 5 minutes here. I'm sorry I packed a lot in today. I'm swinging back to real estate again because I keep talking about real estate. You may never do a real estate gift for a plan gift in your career, but this helps us understand the full picture of plan giving. Well, here's an example. Donor wants to transfer property to Audubon. Audubon is going to issue a charitable gift annuity based on the fair market value of that property. Again, so we don't know how much you're going to sell for. Fair market value, easily found. Then Audubon's going to sell the property as quickly as possible. Cross your fingers. Because what if it sells for a lot less than we thought it was worth? What happens? It's a charitable gift annuity. You owe whatever you guaranteed to your donor, regardless of what happened to the sale of the property. That's the big problem with real estate for CGA, because you never, ever get the fair market value for something in a plan giving context if it's real estate. It just never works out that way. Again, but let's just take a quick look at what the illustration would look like. So back to my mom's property, my mom's house worth $500,000. She paid $30,000. So let's just say she paid $30,000, and she's got a $250,000 per person free capital gain. So we start calculating her capital gains. This is a review from last week, if you didn't notice. We start calculating how much capital gains is from $280,000 to between $500,000. So $220,000 capital gain that she could avoid by putting her house into a charitable remainder unit trust, a flip unit trust, by the way. I didn't put the sorry. It's for CGA. Sorry, mix it up. For a charitable gift annuity. So what would have happened had we done such a deal? She was entitled. She was say age 72, 5.4%. Her income tax deduction was not bad. Capital gains not taxed, not bad. She's avoiding a $93,000 capital gains. And she gets $27,000 a year payments. I wanted to make a note. If this was a husband and wife situation, this isn't why I want to try to teach you this point about the free capital gains, $250,000 per person, free capital gains. If it was a husband and wife, it would have been $500,000 free capital gains, and you could have said to your donor, well, you don't need to even, if you want to avoid capital gains, you don't even have to worry about it because you paid $330,000 and you have $500,000 of free capital gains, and you're selling it for $500,000. I mean, there's no capital gains, so why don't you sell the property and take the cash, and then you can do a gift annuity with the cash, or you can do what you want with it. That's really the point I was trying to make. So how much can a property sell for? That's always the question. How quickly can we sell it for? Do you have a buyer waiting in the wings? Legally, you're not supposed to have a buyer waiting in the wings, but practically, you cannot go ahead and do one of these things, any of these things really, without knowing and having a decent idea who your buyer is going to be. That's why I mentioned I was working on a flip CRUT. I was being paid to draft the document and help an institution with a big property that was going to go into a charitable remainder flip unit trust, and they had a buyer already lined up. Not there's no legal contract to sell the property. That would kill the deal. But they knew who the buyer was, and then they found out there were some issues with the buyer being able to actually buy the property, and boop, the deal died. So they didn't want to take a chance on going ahead and putting the farm into the charitable remainder unit trust because their buyer, something had changed, and their buyer wasn't quite ready to be a buyer, and they didn't want to just put it into the charitable remainder trust without any idea of selling it. So can you have a buyer waiting in the wings? You're not allowed to, but you better have one close by. The big question, again, if you ever get forced into considering charity, there are reasons why you might have to turn to charitable gift annuity. I don't want to get not part of this class, but there may be reasons why you have to consider a charitable gift annuity in a real estate situation. You always have to ask your donor to be able to be willing to take a lower CGA payment if the sale price is lower than expected. That's just goes without saying. If the donor's not willing to do that, the donor's not charitable. If the husband and wife, again, I mentioned it, they have $500,000 free capital gains, they may not need to do this gift. Again, I put down here, I always tell people, charitable flip unit trust, a better option. I said, stay tuned. We already covered it, but okay. Anyway, all right, last takeaways. This is for our case studies. A couple case studies. Deferred and flexible giving needs, great options for having at your disposal. You want to steer donors away from trying to create annuities for youngsters, which will come up, but we want to stay away from that. We want to steer donors away from the idea that this is Audubon, but it's obviously your charity. We don't want donors to think that we're going to convert real estate into high income stream for them. I mean, sometimes donors they're not looking at the charitable light. They may be charitable, they may like you guys, but they're looking at, wow, I need cash flow, and this is a great way to create cash flow. But what if there's no buyers for the property? And you're going to have to be guaranteed the cash flow? Not a good idea. Great. So we hit the and let me open up the call because we're already at 1:16. Let me open up the call, unmute it, and see if anybody has any comments or questions, and then we'll call it a day. Hold on one second. Okay, any questions? Anything? I went through a lot today. Sorry I poured it in, but I tried to keep it simple. Well, next week, so this was our 5th session. Wow, time is flying. I think next week's our last session. That's right. So next week we'll do a little review of these life income gifts, and then we'll get into swing back to the testamentary options and just try to cover them. And please, if you get a chance, take a look at that survey I sent out to everybody. If you guys didn't notice, I sent a bulk email to anybody who's ever taken the Plan Giving Boot Camp. I'm just trying to test the waters on a couple different ideas. Love to get people's opinions on those. And that's all. Any comments? Questions? All right. Well, thank you, everybody. I'm going to end the recording, and we'll see you next week. Bye-bye, everybody.
Bye.